Okay, let's get rocking and rolling. Good morning. Welcome to our Saturday class. Today we're going to be talking about scale trading and commodities. Which is basically, commodities are built. Commodity trading was created as insurance, actually, a way of participating in the futures market. And this will explain it to you. They're goods, not bads. Scale trading and commodities. Trying to get my slideshows to roll. Using options and futures. Now, this is Commodity Trading School, which is a DBA of RCM Alternatives, the brokerage services out of Chicago, and this is our trading education division. I'm in Las Vegas, Nevada. Woo woo. My general contact information, we have a work number, 430-1175. We're toll free, 877-270-8403. Website, which I'm still will be working on again this weekend. Any questions so far? These are risk disclaimer. Trading in futures and options involves substantial risk of loss, and past performance is not indicative of future results. Trading futures and options involves substantial risk of loss. It's not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You could lose more than your original investment selling investment. Now, we're not going to be talking too much today about selling options, but it does, if you decide that you want to be an option seller or option writer, it involves a limited risk of loss and subjects the investor to the possibility of margin calls. A lot of people, because they hear the word option, get a misconception. So we're not going to be talking about shorting options today, but we'll cover them in another class. Any decision to purchase or sell as a result of the opinions expressed in this report will be the full responsibility of the person authorizing such a transaction. Now, all elements of this webinar are the property of Commodity Trading School may not be reproduced or rebroadcast without written permission, like a note from your mother, I guess. Any trade strategies created in this webinar are designed for illustration for alliterative, too early in the morning, purpose unless it's specified otherwise. Responsible parties should consider all risks and potential losses before undertaking futures trading. A little bit more about me. Yes, I started Commodity Trading School in 2003 online. Before Commodity Trading School, we were teaching trading by, before the internet. It was an arduous process where, we were paper trading, helping teach people how to trade by paper trading with them, and then taking them live. But anyway, I've been in the business for over 30 years. I started in 1983, and I'm still here. Well, at least till Monday. It's exciting. But anyway, Monday I go for brain surgery. Ooh, yeah. Anyway, I'm currently a branch manager for RCM Alternatives. I've been a regular contributor over the last 35 years to various industry publications. I've been profiled in magazines, been on the cover of magazines, and I wrote a book. And I shaved my mustache. Let's start out by what is scale trading. You guys can see good, correct? Can you hear good? Somebody type a Y into the question thing and just let me know. Gypsy, good seeing you. Boys, girls, everybody. Scott, Gary, George. Too many names to mention. But I love you and thank you. Okay, what is scale trading? Scale trading is a disciplined and mechanical approach to commodity trading. It has nothing to do with the thing in your bathroom. Just as any trading strategy, the premise is to buy low and sell high, which is the key to trading. Buy buying low, selling high. If it's that easy, why do so many people fail? Well, let's take a different look at this. Everybody knows what this is. I want you to sing out loud, do, re, mi, fa, sol, la, ti, do. This is a musical scale. Starts at the low note, goes to the high note. The premise of scale trading is it's like a reverse musical scale. We start at the, as the market comes down and dips in the scale, we do a backward scale. Dollar cost averaging. Remember, I can't even say this backwards. But scale trading is like a reverse musical scale, starting at the high note and working your way down to the low note. And it's based on dollar cost averaging. The basis of scale trading strategy is a dollar cost averaging of commodity as the price falls, which goes against what most traders believe. However, this investment rule doesn't always apply to commodity trading due to the nature. However, this investment rule doesn't always apply to commodity trading due to the nature of the beast, meaning that commodities have true cost of production, and thus a point where producers stop producing because it wouldn't make sense economically. Commodities are goods, not bad. Scale traders are attempting to profit from the fact that commodities have intrinsic value and cannot drop below production costs for an extended period of time. After all, they're goods, not bads, and will never be worthless. They can't go to zero. Give me a second, I gotta shut up the mic. So anyway, they're goods, not bads. They can't go to zero. They'll always have intrinsic value. Now, stocks can go worthless, and stock companies can go out of business, but commodities such as crude oil, soybeans, corn, wheat, they can't go to zero. They'll always have basic intrinsic value. So when the price of a commodity falls below production cost, growers usually cut back production or even switch to another crop. The resulting decrease in supply will historically push prices back higher. They say every picture tells a story. To an analyst, so does a chart. The low price levels show about where the cost of production is thought to be. Now this is a cotton chart, and as you can see going back years and years, every bar on this chart is a month, represents a trading month. This is called the long-term chart. Now we use long-term charts to get an idea of where the market actually is. And according to this chart, for years and years, you see 52.30 as a price, and that's where we were thinking that the cost of production is. The first step in scale trading is to determine if a market fits the desirable requirements, trading near historic lows. We look at longer-term charts like a monthly to identify a market's long-term trading range in an attempt to get a better idea of what's considered to be a low price as well as a high price. Over the last 10 to 20 years, this information would be essential in determining when and where you should consider using a scale trade, or whether the market's at a low price or a high price. Any questions so far? The commodity markets are price sensitive, and prices are driven by supply and demand, whether real or just perceived. For example, a low supply situation is usually represented by higher prices. Once this occurs, producers will be attracted to the higher prices and will once again begin producing more of the commodity. Thus the saying, make hay while the sun shines. Get it? This starts the process all over again, so when prices are low, farmers tend to plant less of a crop, which will eventually lead to a shift in lower supply, which leads to higher prices. Market goes in a circle. This is called the consumption circle. Any questions so far? Is the most exciting thing you can be doing on a Saturday morning? Absolutely. Especially when prices are trading near the upper end of a historical valuation. High prices entice more producers. The eventual increase in supply will usually force prices lower. We're all on the same page. Any questions so far? However, reverse scale trade or selling scale trade is not necessarily recommended. When prices get to the high end of their envelope, the end users get nervous that they might run out or go outside their budget, so they tend to increase buying. They're buying quantities in larger quantities to make sure they have some so they don't run out. Remember, there's people out there whose job is to, think about Kellogg's. Kellogg's needs to buy corn to make cornflakes. And when the prices are low, they're comfortable. But when prices start getting higher, they get nervous and they increase their buying to try to stay within their budget. Do you understand that? Pretty basic, pretty easy. But commodities are unique in the fact that they cannot go to zero. Thus, while scale trading could be applied to other investments such as stocks, this strategy works best in the futures market. Give me a second, I gotta clear my throat. Scale trading is best applied to Mother Nature commodities like grains, energies, and fiber being cotton, preferably those that are grown for human consumption. Historically, these types of commodities ensure that even the worst case scenario will eventually lead to a price recovery. Now, growing up, you always heard stories. I remember the one out of Florida where the prices of oranges had dropped so low that farmers, it wasn't worth the money that it cost them to pick them. And they were taking the oranges and dumping them in the Indian River, which was environmentally bad, but economically, that was it. Or farmers, even a more common thing, farmers plowing, the price of wheat dropping so low that it wasn't worth them harvesting it because it costs money to harvest. Not only got to harvest it, but you also have to ship it. So farmers would be plowing their wheat over because there was too much wheat on hand and the market value dropped to a point where it's not worth anything. Do you guys remember these stories? Haven't heard any lately, and there's a reason for that. Anyway, so on the other hand, financial assets such as currencies, bonds, and stock index do not have a cost of production, making them vulnerable to severe devaluations and should be avoided by scale traders. Now, some of the problems with scale trading involves buying in a weak market and hope that prices will reverse. However, it could be a considerable period of time before prices do in fact turn around, forcing scale traders to sit on huge losses. Looking for a bottom, scale traders are attempting to take advantage of a market's perceived low price based on historical pricing. We have all heard that picking tops and bottoms are nearly impossible, and it's true, but not impossible using this right trading strategy. Let's go take a look at something real quick. The grain market. This is Track and Trade Pro charting software. I use it for a lot of my analysis. Let's go look at corn. We're going to look at corn on a long-term basis. Look at July corn right now. Open this chart. And on a daily chart, you're saying, well, what about it? Market did a hook shot here. But if you look at corn on a monthly basis, now you see where the price is now compared to years ago. And now it looks really cheap. Let's go adjust our chart to get more information in the box. This is a scale trader's dream, or any trader's dream. But in order to really understand this, you got to go back in time. We're going to go back and look at corn prices. Okay, bear with me. This is all important. We're going back to the 60s. All right, all you guys that were like trading in the 60s, thank you. But looking at the chart, we're going to identify the high back in the 60s, the average high. The market was staying under this red line. And as it goes, so this was a high price for a commodity in 1967. And then all of a sudden the market ran in the early 70s and peaked out in 74. Do you guys remember 74? I barely do. But I do remember, like, that's when, things got crazy. I believe OPEC was created. The market ran all the way up. Corn prices ran up to $4. God forbid. So anyway, the old high before the inflationary spike that occurred in the 70s became the new low carrying forward. So this was considered the cost of production in the 50s and 60s. It was under $1 a bushel, corn under $1 a bushel. Then it went up, and then the old high became the new low here. And I don't know why it works that way, but it does. And then we had the 80s. You had a drought, the 80s, and then you had a drought here. And then the old high will become the new low. Now, I don't know why this works this way. It just does. You go forward. Then you had the inflationary spike in the new millennium. And this is where we're considering the cost of production is now, about $3.10 a bushel. So this is your roadmap to trade off, to get an idea of where we're at. What's something worth is the age-old, the $64,000 question. Corn prices, so figure 350 is the cost of production. We came down low to that. So looking for the bottom. Scale traders are attempting to take advantage of a market's perceived low price based on historical pricing, which we just went through. Does anybody? I know I kind of went through it fast. Did anybody have any questions? Ian, how's everything in Australia? Now, even if many traders and analysts agree that prices are unusually low, a market may sit at the lower end of its historical price range for a long period of time. Many long positions will essentially give up and force prices even lower. So what you think is low today may be high tomorrow. In other words, scale trading requires excessive amounts of patience and financial backing. And it's our job as traders to come up with ways to make it doable. So we got to be creative sometimes. So let's go look at a scale and how you set a scale up. Now, by the way, every Monday through Friday at 5:20 a.m., I do a day trading class. I've seen, a lot of you guys are aware of that, and I see you participate in that class. Yet there's others that, I guess you don't wake up at 5:20 a.m. Pacific. But it's worth it. But it's the same practice that we do it with, even though I just said, scale trading with financials doesn't really make sense. We're combining scale trading with a technique known as scalping. That's another class. You got to come on Monday. Okay, the steps to scale trading is first you look at the markets and you find an undervalued commodity. You go through all your charts and you look for commodities that are trading at the lower end of their price envelope. From there you determine the scale. Then you calculate the necessary capital needed to participate in the scale. And then you place a series of buy limit orders. As the market goes down, you want to buy. Remember the reverse musical scale? Like if you love buying it at, say, $5, you got to like it even more buying it at $4.50. And it's got to be really exciting to buy it at $4. I know. Hang on, let me get rid of that pen. Okay, now this is pretty important. You might want to write this down. FIFO versus LIFO. Those are important terms. I know it sounds silly, and I know it's not the name of a dog. The standard accounting procedure practiced by most clearing firms is called FIFO. Clearing firms, where all your transactions and your bank and your trading is done through a clearing firm. I'm what's known as an introducing broker. Yes, I'm the guy that gets to wear a silk suit and tie and look good while you're trading. Okay, FIFO. What does it stand for? Pretty easy. First in, first out. Meaning that when offsetting existing positions, they take off the first positions established, which isn't bad but can get confusing when scale trading, because as the market's going down, you're increasing your buying, and so you'll be getting out of the highest price first, which on paper looks like a loser. So you want to switch your accounting procedure from FIFO to LIFO to scale trade. You understand that? Is there any questions? Hang on, I lost my mouse. Alright, where'd my mouse go? There it is. This computer is on its last leg. It'll be replaced over the weekend, so bear with me. How embarrassing. Give me 1 second. Let me try this. boys and girls. Give me a second. I don't understand what could be happening. Let me try something a little drastic. Hang on. You guys can still hear, right? The computer like froze up. Give me a second. Anyway, boys and girls, you're looking at a commodity. This is the gained trading platform. As I try to figure out what happened to okay, hang on. Watch this. We're going to get really tricky. Do you guys know what a hard break is? A hard boot is? That's what I just did. How exciting is that? You guys can still see and hear I'm rebooting that computer. It'll only take a second. It's crazy, I know. How embarrassing. On weekends is when we have like our IT people come in and do their work. And my guy's supposed to be here later today, and we have a new computer right out of the box, because this computer gets the crap beat out of it. It's exactly what I did, Scott. A hard boot. Pretty scary. But anyway, scale trading, like we're looking at the grains right now. As we're going into the spring, farmers get ready to plant. Gary, did you start planting yet? We do have actual farmers in this class. Okay, the computer's restarting over here.